The global mining sector is currently undergoing a structural transformation that matches the scale of the industrial revolutions of the past 2 centuries. This transition is defined by the move away from fossil fuel-intensive energy systems toward a decentralized, electrified global economy. At the center of this metamorphosis is copper, a metal with no viable large-scale substitute for conductivity and energy efficiency. Within this macroeconomic context, Lundin Mining Corporation has emerged as a particularly compelling subject for investment analysis. Over the past 5 years, the company has executed a radical strategic repositioning, transitioning from a diversified, multi-jurisdictional producer of various base metals into a concentrated, high-margin copper specialist with a primary operational focus in the Americas. This shift is not merely a change in geographic footprint, but a fundamental reimagining of the company's role in the global supply chain, positioning it as a key beneficiary of the looming structural deficit in copper supply.
The investment thesis for Lundin Mining rests on 3 distinct pillars that differentiate it from its senior mining peers. The first pillar is the high quality and longevity of its existing operational core in Chile and Brazil, which provides the cash flow necessary to fund growth. The second pillar is the company's aggressive and successful portfolio optimization, characterized by the timely divestiture of non-core European assets and the acquisition of value-accretive copper operations in the Atacama region. The third, and perhaps most significant pillar, is the company's 50% interest in the Vikunia district, a massive multi-decade copper-gold-silver province that is being developed in partnership with BHP. This district represents one of the most significant mineral discoveries of the past 30 years and provides Lundin Mining with a clear path to becoming a global top 10 copper producer. The strategic evolution and corporate rebirth of Lundin Mining. To understand the current value proposition of Lundin Mining, it is necessary to examine the systematic transformation orchestrated by its leadership between 2020 and 2024. During this period, the company moved away from a model of broad geographic and commodity diversification. Historically, Lundin Mining held significant assets in Europe, including the Neves-Corvo mine in Portugal and the Zinc-Gruvan mine in Sweden, which produced a mix of copper, zinc, and lead. While these assets provided stability, they also introduced operational complexity and were located in jurisdictions that, while stable, did not offer the same geological scale or growth potential as the Andean Copperbelt. The pivot toward the Americas began in earnest with the move of the company's head office to Vancouver in 2023, signaling a renewed focus on the Western Hemisphere's primary mining jurisdictions. This was followed by a series of transformative capital allocation decisions totaling over $4 billion. The company's strategy was defined by a commitment to operational excellence, geographic concentration in Tier 1 jurisdictions like Chile and Argentina, and the optimization of its asset portfolio to prioritize copper-dominant systems. By the end of 2024, the company had successfully increased its geographic concentration in the Americas to over 80% of its total production, a move that aligned its interests with the world's most prolific copper-producing regions.
The divestiture of the European assets to Boliden in early 2025 for $1.52 billion was the final step in this portfolio refinement. This transaction allowed the company to streamline its management focus and strengthen its balance sheet at a time when capital intensity in the mining industry was rising due to inflation and the technical challenges of deeper mining. The sale also shifted the company's revenue mix to be even more heavily weighted toward copper, which management identified as the primary driver of long-term shareholder value. The financial flexibility gained from this divestiture has been instrumental in allowing the company to pay down debt and fund expansionary capital expenditures without diluting shareholders during a period of rising interest rates. Operations in the Chilean copper core. The operational heart of Lundin Mining is located in Chile's Atacama region, where the company operates the Candelaria and Caserones mines. These 2 assets collectively represent the vast majority of the company's production and cash flow. The strategic logic of holding both assets is rooted in the significant synergies that can be realized through their proximity. These include shared use of port facilities, water desalination infrastructure, and supply chain logistics, which reduce the overall cost profile of the operations.
The Candelaria Copper-Gold Complex. Candelaria is the cornerstone of Lundin's portfolio, an asset that has demonstrated remarkable resilience and longevity. The complex includes the Candelaria and Ojos del Salado copper mines, which produce copper concentrates from both open-pit and underground sources. A major milestone for this asset was achieved in late 2023 with the approval of the Candelaria 2040 Environmental Impact Assessment. This regulatory victory extended the projected mine life by an additional 10 years, moving the closure date from 2030 to 2040. This extension is not merely a temporal delay of closure, but a strategic opening that allows for the development of the La Española open pit and the expansion of the Candelaria underground mines. In terms of production performance, Candelaria has consistently met or exceeded its targets. In 2024, the mine achieved some of its best second-half results in its 30-year history, producing nearly 100,000 tons of copper in the final 6 months of the year. For the 2025 fiscal year, the company has guided for copper production between 140,000 and 150,000 tons at Candelaria on a 100% basis. Gold production at the site is expected to range between 78,000 and 88,000 ounces. The cost profile at Candelaria remains highly competitive, with C1 cash costs forecast between $1.80 and $2 per pound of copper.
However, investors must consider the impact of the gold and silver streaming agreement that covers 68% of Candelaria's precious metal production. Under this agreement, the company receives approximately $433 per ounce of gold and $4.32 per pound of silver, which significantly limits the upside from rising precious metal prices while providing a predictable base of byproduct credits that lower the reported copper cash costs. Despite this, the underground expansion project is expected to increase throughput capacity by 50 to 60%, reaching approximately 22,000 tons per day, which will further improve the economies of scale at the site. Caserones and the value of counter-cyclical acquisition. The acquisition of a 51% stake in the Caserones mine in 2023, followed by an increase to 70% in 2024, represents one of management's most effective capital allocation decisions. For a net cash investment of $721.1 million, Lundin acquired a large-scale producing copper molybdenum operation in a premier mining district. The capital intensity of this acquisition was roughly $13,500 per ton of copper, which compares very favorably to the $22,000 to $25,000 per ton required for new greenfield developments. Since taking over operatorship, Lundin Mining has focused on a full potential program to optimize the asset. The results have been immediate and significant. In the third quarter of 2025, Caserones produced 35,000 tons of copper, a notable increase from the 29,000 tons produced in the second quarter. This strong performance was driven by higher head grades and improved cathode production, which has nearly doubled since 2023. The company's ability to extract more value from an existing asset that was previously underperforming is a testament to the operational expertise of the Lundin Mining team.
For 2025, Caserones is expected to produce between 115,000 and 125,000 tons of copper on a 100% basis. While its cash costs are higher than Candelaria's, initially guided at $2.40 to $2.60 per pound, the company has been able to lower its consolidated cost guidance due to the efficiency gains realized at Caserones. The mine has 5 remaining phases in its life of mine plan, focusing on the higher value material in the earlier phases to maximize net present value. The integration of Caserones has not only increased Lundin's total copper production by approximately 47% over 4 years, but has also provided a second major cash flow engine in Chile. Diversification and optimization in Brazil and the United States. Beyond its Chilean core, Lundin Mining maintains significant operations in Brazil and has strategically managed its exposure to the nickel market in the United States. These assets provide additional commodity diversification and have served as critical components of the company's cash flow during its period of rapid transformation. The Chapada mine in Brazil. The Chapada mine, acquired in 2019, is a high-quality copper-gold operation located in a stable mining jurisdiction in Brazil. It serves as a vital source of low-cost copper production due to its substantial gold byproduct credits. In 2024, Chapada produced 43,261 tons of copper and 65,415 ounces of gold. For 2025, production is guided at 40,000 to 45,000 tons of copper and 57,000 to 62,000 ounces of gold. Management has identified Chapada as a candidate for brownfield expansion, with a focus on improving throughput and recovering more metal from the current ore body. The mine's C1 cash costs for 2025 are expected to be between $1.80 and $2.0 per pound of copper, benefiting from lower treatment and refining charges. Exploration at the site remains a high priority, with drilling focused on the Saúva area to expand high-grade resources and potentially extend the mine life beyond current projections. The stability and margin profile of Chapada make it an essential component of Lundin's ability to fund its more capital-intensive projects in Argentina.
Strategic exit from Eagle and the nickel play. The Eagle mine in Michigan has been a consistent producer of nickel and copper, but as a smaller, shorter life asset, it no longer fit the company's vision of focusing on large-scale copper operations. In December 2025, Lundin announced the sale of Eagle and the Humboldt mill to Talon Metals. This transaction was structured strategically. Rather than receiving cash, Lundin took 275.2 million shares of Talon, representing a 19.99% stake in the company. This move allows Lundin Mining to streamline its portfolio while retaining significant upside exposure to the U.S. domestic nickel and copper market. Talon Metals is developing the Tamarack project in Minnesota, and the use of the Humboldt mill to process Talon's ore creates immediate operational synergies. By becoming the largest shareholder in Talon, Lundin maintains a toehold in the critical minerals sector of the United States, while freeing up its own management team to focus on its primary South American copper drivers. Eagle's production, which accounted for only about 2% of Lundin's consolidated copper output, was a non-core part of the long-term growth story, and the sale effectively transforms Lundin into a near-pure-play copper vehicle for investors. The Vikunia district, a generational growth catalyst. The most powerful element of the Lundin Mining investment thesis is the company's 50% interest in the Vikunia district, a world-class mineral province discovered on the border between Argentina and Chile. This district, which includes the Josemaria and Filo del Sol deposits, is recognized as one of the largest copper, gold, and silver resources in the world. The strategic decision to form a joint venture with BHP to develop this district has fundamentally changed the risk and reward profile for Lundin Mining shareholders. The partnership with BHP and the Josemaria project. Developing a district of this scale requires immense capital and technical expertise. The partnership with BHP brings together Lundin's entrepreneurial spirit and regional knowledge with the operational systems and financial strength of the world's largest mining company, Five. This collaboration de-risks the project significantly, as BHP provides access to global procurement chains and world-class project management standards.
The Josemaria project, located in Argentina San Juan province, is the most advanced asset in the district. Recent optimizations by the joint venture have extended the projected mine life from 19 to 25 years, a 31.5% increase that adds significant long-term value to the project. Josemaria is expected to have a processing capacity of 175,000 metric tons per day, making it one of the largest copper operations globally. The combined resources of Josemaria and the neighboring Filo del Sol deposit contain approximately 13 million metric tons of copper and 25 million metric tons of inferred copper, alongside substantial gold and silver credits. Navigating the Argentine regulatory landscape, RIGI and PELP. One of the primary historical risks for mining in Argentina has been the country's economic and regulatory volatility. However, the introduction of the Incentive Regime for Large Investments, RIGI, in 2024 has created a much more favorable environment for long-term mineral development. In December 2025, Vikunia Corp became the first mining company to apply for the RIGI under the Long-Term Strategic Export Projects, PELP, designation. The benefits of the RIGI PELP framework are tailor-made for a project like Vikunia. It offers a 40-year period of fiscal stability, which protects the project from future tax increases. It also provides a lower corporate tax rate, the removal of export duties, and accelerated timelines for the repatriation of revenues. For a project estimated to require between $15 billion and $17 billion of investment over the next decade, these protections are essential for securing the necessary financing and ensuring that the project remains competitive on a global scale. The submission of the RIGI application is a clear signal of management's confidence in the Argentine jurisdiction and a key milestone toward a final investment decision. The integrated technical report for the Vikunia project, expected in the first quarter of 2026, will be a major catalyst for the stock. This report will outline the definitive economic benefits, capital requirements, and production schedules for the joint development of Josemaria and Filo del Sol. Analysts expect the project to begin production by 2030, positioning Lundin Mining to deliver a massive increase in copper output, just as the global supply deficit is projected to be at its most severe.
Financial strength and the capital allocation framework. Lundin Mining's financial performance over the past 2 years has been characterized by strong cash generation and a disciplined approach to the balance sheet. In the 2024 fiscal year, the company generated $4.117 billion in total revenue, with adjusted EBITDA of $1.707 billion. The third quarter of 2025 was a record-breaking period, with the company generating over $1 billion in quarterly revenue and delivering $383 million in adjusted operating cash flow. Net debt reduction and cash generation. One of the most impressive aspects of the company's recent performance has been the rapid reduction of its debt. Following the sale of its European assets for $1.4 billion, the company significantly strengthened its balance sheet. By the end of the third quarter of 2025, net debt, excluding lease liabilities, had fallen to just $108 million. Management has indicated that the company is on track to be net debt-free by the end of 2025, a position that provides it with maximum flexibility to fund its growth initiatives. The company's ability to generate free cash flow remains robust, even as it invests heavily in its growth projects. In the third quarter of 2025, free cash flow from operations reached $168.9 million. This financial strength is a direct result of the company's focus on high-margin copper production and its ability to maintain low cash costs across its primary operations. The consolidated copper cash cost guidance for the full year 2025 was recently lowered to a range of $1.85 to $2 per pound, reflecting the operational improvements at Caserones and Chapada. Shareholder returns and distribution policy. Despite its aggressive growth profile, Lundin Mining remains committed to returning capital to its shareholders. The company targets an annual distribution of approximately $220 million through a combination of dividends and share buybacks. In 2025, the board updated its policy to pay a regular quarterly dividend of $0.0275 per share, representing an annual yield of approximately 1.1% at current prices.
The company also utilizes a normal course issuer bid, or NCIB, to repurchase its own shares, a strategy that management believes provides a more flexible way to return capital when the stock is undervalued. So far in 2025, the company has acquired over 13.6 million shares at a cost of approximately $122 million. This balanced approach of returning capital while simultaneously funding generational growth projects is a hallmark of the Lundin family's value creation philosophy and distinguishes the company from many other high-growth miners that must continuously tap the equity markets for capital. The macroeconomic outlook for copper, a structural deficit. The investment case for Lundin Mining is underpinned by the unprecedented fundamental strength of the copper market. Analysts from major investment banks like JP Morgan and UBS have recently revised their copper price forecasts upward, with some projecting prices to reach $13,000 per ton by late 2026. This optimism is driven by a convergence of supply constraints and the accelerating demand from the global energy transition. Demand drivers, electrification, and artificial intelligence. The primary driver of copper demand is the global shift toward electric vehicles, or EVs, and renewable energy infrastructure. A single electric vehicle requires nearly 4 times as much copper as an internal combustion engine vehicle, and the build-out of EV charging networks is equally copper-intensive. Furthermore, the rapid expansion of data centers to support the growth of artificial intelligence is emerging as a significant new source of demand. JP Morgan research suggests that data center installations could account for 475,000 metric tons of copper demand by 2026, an increase of 110,000 metric tons over current levels. On the supply side, the mining industry is struggling to keep pace. Many of the world's largest copper mines are maturing, facing declining ore grades and increasing technical challenges. For example, major disruptions at the Grasberg mine in Indonesia have significantly reduced global mine supply growth estimates to just 1.4% for 2026. This lack of new supply, combined with the 8 to 12-year lead time required to bring new mines into production, has created a structural deficit that is expected to persist for the remainder of the decade. Lundin Mining, with its significant production growth from Caserones and its massive pipeline in the Vikunia district, is perfectly positioned to fill this supply gap.
The role of copper in a geopolitically fragmented world. In addition to the energy transition, copper is increasingly viewed as a strategic mineral for national defense and digital sovereignty. As countries compete to build their own AI infrastructure and modernize their power grids, the competition for secure copper supplies is intensifying. Goldman Sachs research has highlighted that demand for copper from grid and power infrastructure will drive more than 60% of total copper demand growth until 2030. This structural demand makes copper prices less sensitive to traditional economic cycles and provides companies like Lundin Mining with a more stable and predictable long-term revenue outlook. Valuation and competitive landscape. As of late 2025, Lundin Mining stock has performed exceptionally well, with a year-to-date return of over 111%. This rally has been driven by the company's consistent operational beats and the growing recognition of the Vikunia district's potential. Despite this surge, the stock continues to trade at multiples that reflect its growth profile rather than a peak cycle valuation. Multiples and peer comparison. Lundin Mining currently trades at an EV to EBITDA multiple of approximately 8.7x and a price-to-earnings ratio of roughly 35.5x. While these multiples are higher than the industry average for diversified miners, they are comparable to or lower than other high-growth copper producers. For instance, Southern Copper trades at an EV to EBITDA of 16.0x, reflecting its massive reserve base but its much slower growth rate. Ivanhoe Mines, which is also ramping up a world-class copper discovery in the DRC, trades at a PE ratio of 46.2x. The market appears to be assigning a copper premium to Lundin Mining, but it has not yet fully priced in the value of the Vikunia district once it moves into construction. Analyst consensus for the stock remains a buy, with many institutions raising their price targets in response to the company's recent cost reductions and production guidance increases. Zacks Investment Research recently noted that the consensus estimate for Lundin Mining's fiscal 2025 earnings has moved up significantly, indicating a 68% year-over-year improvement.
The investment narrative: value versus growth. The debate among investors regarding Lundin Mining often centers on whether the stock is fairly valued or remains a compelling bargain. While some valuation models, such as simple dividend discount models, suggest the stock is overvalued, these models often fail to account for the massive options value of the company's exploration pipeline and the high probability production growth from the Vikunia district. For long-term investors, the focus is not on current multiples, but on the company's ability to grow its cash flow per share as it moves towards its goal of producing over 500,000 tons of copper annually. Risks and mitigation strategies. While the investment case for Lundin Mining is robust, it is not without risks. These include the cyclical nature of commodity prices, the inherent operational risks of large-scale mining, and the political and regulatory challenges of operating in South America. Commodity price and inflationary risk. Lundin Mining is inherently exposed to the volatility of global metal prices. While the long-term outlook for copper is positive, a global economic slowdown or a faster-than-expected increase in supply could lead to temporary price declines. Furthermore, the mining industry has been hit hard by inflationary pressures on consumables, labor, and equipment. Lundin has mitigated this risk by focusing on cost optimization programs like Candelaria Excellence and the Caserones Full Potential Program, which have successfully lowered the company's consolidated cash costs even in an inflationary environment. Jurisdictional and political risk. Concentrating assets in Chile and Argentina introduces geopolitical risk. Chile's new mining royalty structure increases the tax burden on the company's most profitable operations, although tax stability agreements provide a buffer in the near term. In Argentina, the political climate has historically been less predictable, but the current government's introduction of the RIGI framework suggests a significant pivot toward pro-mining policies. Lundin Mining mitigates these risks by maintaining strong relationships with local governments and communities and by partnering with BHP, whose global presence provides an additional layer of diplomatic and operational security. Execution risk in the Vikunia district. The development of the Vikunia district is a massive, multi-decade undertaking. Projects of this size often face technical challenges, permitting delays, and cost overruns. The joint venture with BHP is the primary mitigation strategy for this risk, as it allows the two companies to pool their technical and financial resources. The upcoming Integrated Technical Report in 2026 will provide more clarity on these risks and the specific engineering solutions that will be used to bring the project into production. Conclusion: the strategic value of Lundin Mining. Lundin Mining Corporation represents a unique opportunity for investors to gain exposure to a high-quality, high-growth copper producer during a period of structural market deficit. The company's successful transformation over the past 5 years has created a focused, financially strong entity that is uniquely positioned to capitalize on the global energy transition. Its core assets in Chile and Brazil provide the stable cash flow necessary to support its growth, while the strategic acquisition of Caserones and the divestiture of European assets have streamlined the company's operations and strengthened its balance sheet. The Vikunia district, developed in partnership with BHP, is the true growth engine of the company. It provides Lundin Mining with a clear and credible path to becoming a global top 10 copper producer by the end of the decade. The regulatory support from Argentina's RIGI framework and the technical expertise of the joint venture team significantly de-risk what is undoubtedly one of the most important mining projects in the world today. Financially, the company is in its strongest position in history. Being net debt-free while simultaneously returning capital to shareholders and funding generational growth is a testament to the management's disciplined approach to capital allocation. For investors who recognize the irreplaceable role of copper in the future economy, Lundin Mining offers a compelling combination of operational and strategic focus and world-class growth potential. As the global supply gap for copper continues to widen, companies with the asset quality and growth pipeline of Lundin Mining are likely to be among the primary beneficiaries of the new commodity supercycle.